On your agricultural fund,
yes.
Do you have some agricultural investment that is exposed to the prospect of greater dietary demand in emerging economies like China?
Absolutely. I mean, it's one of the toughest parts of the agricultural call that, of course, it is very dependent on the notion of either consumption being maintained or indeed growing in favour of protein, so the replacement of rice was becoming more carnivorous, if you will. I believe that's going to take a knock. That is going to go into reverse because of the economic situation. And I'm not the only one. Agricultural shares have collapsed since July. They're down 75%. I'm not buying the table saying buy agricultural shares for the next 12 months or indeed the next 24 months. I think returns over that period are random. But I point out to you, it's an unleveraged part of the world economy, agriculture.
Well, just on that point, I mean, would you agree with that?
There's a fund manager or a portfolio manager out of Switzerland writes in, Hugh, if China growth is not real, then who's going to buy US T-bonds to finance the budget deficit? Why being bullish on US long bonds if you have such a deficit and no one to bid at auctions?
People are going to be buying US Treasury bonds, A, because the dollar's going up and because the Treasury bonds are going up. And that's a lot more attractive than owning a Chinese equity, a Chinese property, or indeed owning an equity anywhere in the world.
But are the Chinese going to be able to fulfil their previous share of the financing of the US consumption?
I suspect they will. There's an old economist law named after a Frenchman, Say's law. Supply creates its own demand. Yeah? And it's counterintuitive. We are having a profound economic difficulty because we took savings around the world to zero in the Western world, and those savings now are retracing. Yeah? And as you save, you create a pool of investment funds available to buy those Treasury bonds. So, And
I'll just jump in. A number of emailers writing in this morning about sovereign debt in Europe and how confident you can be about there being no default. It's a slightly tongue-in-cheek question, I suspect, but when you look at the likely deficits that are going to be run by the Irish, is it perhaps not unrealistic to anticipate there's going to be some distress in sovereign debt in the Eurozone?
Well, distress is beginning to be priced in to the sovereign debt market. It's extraordinary that the UK trades at 100 basis points over. That's just a little bit that's below McDonald's. So the Big Mac is greater credit than the Treasury. Now, what is more preposterous, however, is that you have UK sovereign being priced pari passu with Portugal, Spain, Italy, right? That is absurd for one very strong reason. The UK has a domestic, it has its own monetary policy, it has its own exchange rate, it's fallen 40%, and that is wonderful, right? These other countries don't have that, and therefore they will break. The euro will break, I believe, if not within 2 years, then within 5 years. So I actually am trading, I'm willing. I think the UK is wrong. Okay, so I'm the other side there. I do think CDS swaps are going to continue blowing out elsewhere. I own Chinese CDSs. I own them in Taiwan. I own them in Mexico. So I'm out there, but interesting.
So maybe
the French and the German are pretty close. The French and German are pretty close together. Norwegian actually trades below Germany, which is odd because if you look at the Norwegian currency, it's been very weak versus the euro. So there's a bit of an absurdity, and that's really the oil price, and there might be opportunities in that cross trade. But it's really pricing the UK alongside the pigs is inappropriate. The Portugal, Italy, Ireland, Greece and Spain, that's an inappropriate valuation when one currency has autonomy over its foreign exchange.
Commodity